Well, g'day there traders and friends right around the world. Thank you so much for joining me in this weekend's Pivot Point Pro analysis workshop. It is a Saturday afternoon down here in Brisbane, Australia. It is Saturday the 7th of March. This analysis is good right up until the open, which will be Monday the 9th of March 2015. Thank you so much again for joining me in this weekend analysis workshop. For those of you who are in here for the first time, it's great to have you in here. I'm going to bring up a few charts outside of the general analysis class, which I go through each weekend, which are very pertinent to the current market and what the market is doing at the moment. For those of you who are loyal and returning students, it's great to have you again participating and watching this analysis recording. I have an assumption that many people are going to want to email me over the next 24, 48 hours. So if you have any questions regarding the next few charts which I'm about to walk through, any of the individual trade setups which I'm going to reference and walk through as well, please email me success@pivotpoint-trading.com. You can also schedule a call with me as well. I've got upwards of about 60 students in this weekend analysis workshop, and I can sit here and say that I do get back within 12 to 24 hours to really 90 or maybe over 90% of inquiries which do come through to me. I do my best again to service all of those questions which you do have, and I schedule a lot of calls with people outside of this analysis class just to make sure that you feel comfortable with the analysis which I walk through each and every weekend. Now, getting back into the analysis this weekend, it's a very timely reminder that I'm going to touch on a few elements outside of the natural type of workshop and technical analysis which I walk through. What I'm referring to is really this theory which we call Dow Theory. And there's three tenets of Dow Theory which I'm going to reference, over the next 15 to 20 minutes. Firstly, as well, before I get into the analysis, is that if you're not in a comfortable state, if you're not settled in, maybe it's a good idea to make yourself a cup of coffee. I do have a feeling that this weekend's class is going to go over, roughly that 70-minute time frame, which it generally takes to walk through these three US markets and, of course, our top 13 individual trade list. So getting back into Dow Theory this weekend, it's very important to reference this and get a good perspective on what we can expect from the market moving forward, because, whenever we sell off 278 points, close to 300 points on the Dow Jones Industrial Average on a Friday afternoon, obviously people have questions and they need those questions answered. Now, first of all, what I'm going to reference is that, first of all, the trend or any underlying trend is assumed to be in effect until it has given definite signals that it has reversed. Now, what I mean by that is that we have been in a multi-year trend on the Dow Jones Industrial Average. We have been in a trend since May 2009. Maybe it's best to summarize this if I zoom out, and I'm going to clear the annotations off from my chart right now. I'm just going to simply click this hide annotation note right here. Now, here we are looking at the monthly chart, and since 2009 we have been in a bullish trend. Now, there have been periods in time when we have suffered and walked through retracements in the overall market, but for the most part, again, a trend is assumed to be in effect. Write this down until we have definitive signals that it has reversed. Now, what are these definitive signals that a trend has potentially reversed? What we are referring to in this particular tenet of Dow Theory is that we set up a trend reversal. What I mean by that is that we have to establish a lower high relative to a higher high and also a lower low. So if we break down the Dow Jones Industrial Average, we are still satisfying the first tenet of Dow Theory. The trend is still in effect. As you can see, we're still making a series of higher highs and we are still making a series of higher lows. The trend is still intact. So if we're going off the first tenet of Dow Theory, yes, it is somewhat of a negative daily candlestick, but we have to keep this in the bigger context of the overall picture. Of course, the monthly overrides the weekly overrides the daily. As swing traders, we trade the minor wave of the overall trend. Now, this is moving into, of course, the next tenet of Dow Theory, which I'm about to reference. That is, of course, that there are three levels to each and every trend. Now, I'm going to zoom out and work on a weekly in this particular case. Now, again, this is a weekly of the Dow Jones Industrial Average. I'm working since 2009, and there are three levels to the trend. The first level is the primary. This is the big level, macro picture of the overall trend. As you see, I'm going to try and draw this with a red line coming up through here. Now, again, I can't make a perfect line. I'm using my mouse, but you can see that the primary level of the trend still remains up, i.e. we are above as price. We are above the primary trend line. Now, this is where we have the two other levels to the underlying trend. Within this primary trend, we have also an intermediate, and I'm going to use this as the green level. Right now, the intermediate more so works like this. You get these intermediate level moves away from the primary trend, and then we pull back into the primary trend. We get these intermediate moves away from the trend, we pull back in, away, we pull back in, away, we try and pull back in. You can see the picture right here. This is what we call the intermediate trend of the market. Now, narrowing down one step further, let me try and find another color here, which you can see. I'll try and make it blue. I'm going to write it over here where I've got a little bit of white space. This is what we call the minor level of the trend. Now, these three trends make the market. It's how the market moves. And this is really the level which we operate on as swing traders. We capture the minor level moves which work in conjunction with the intermediate trend, which works in conjunction of the bigger picture primary trend. So if I was to draw the minor level trend on a weekly chart of the Dow Jones Industrial Average, we're talking about these little moves right here, these little flags and these little bounces which pull back down into the intermediate, which work in conjunction with the overall primary trend. You can see these little movements on the weekly. Again, it's better summarized on the daily, but I'm zooming out and showing you these little snapshots which work in conjunction with the overall green level trend of the Dow Jones Industrial Average. This is not only privy to the Dow Jones, this works on the S&P 500. It also works on the NASDAQ. So I've referenced these two trends at the most recent juncture, zooming in on the weekend, the price action over the weekend. This is where it gets a little bit interesting. Now, again, a lot of people are in a state of panic at the moment. They're sort of saying and sort of transitioning into the weekend, not really knowing what to expect. But if we can tie in these two key elements of Dow theory, we get a very, very good understanding of what to expect for the week ahead. Now, what I'm going to simply do is make sure that I can bring back up my annotations, because this is going to give us a really good structure for the week ahead in the market. Now, going in and zooming down on the minor level of the Dow Jones Industrial Average, this is really referencing the blue cursor, which I was just working with on that previous weekly chart. This is more so the minor level or the daily chart, which is working in conjunction with the intermediate trend. Now, what we can do right here is that we've drawn on this green support level. This is what we had a perspective box, and we were saying to ourselves that as we transitioned into the market last week, we were saying that this market is still somewhat bullish, technically bullish, until we start to break down below this level. Now, I wasn't expecting the market on a Friday to drop close to 300 points. I am going to reference some economic data, which is also surprising and somewhat interesting. I'm going to tie this down into the overall market analysis. But at the moment, we have closed below this hypothetical support box right here. What technical traders do, and this is what professional traders do, they want to get a framework for the market. They want to find out where the market can trade to in a bullish trend. And they want to also find, if I can bring up my red cursor right here, where the market shouldn't be trading in a bullish trend. So simply what I'm going to do, I'm going to remove this rectangular box and I'm going to incorporate the Fibonacci support and resistance levels. And when we do this, we're also operating on the intermediate level combined on the minor level. Now, what we do with this intermediate or with this Fibonacci retracement box is that we find out where the most recent wave ended. And I can say that the most recent wave ended on this particular candlestick. This was on Tuesday, that inside day hangman. And then we can say, well, where did this market start the bullish run? And it really comes from this one particular white candlestick as we began February 2015. This gives us our Fibonacci ranges. Now let me zoom in so you can see these ratios. You've got the 0.382, you have the 0.5 and the 0.618. All these are percentages of this 100% range, and it's giving us some form of subsections as to where a bullish market will hold and bounce from moving forward. So what I'm simply going to do right now is reuse that rectangular drawing tool, and this is much more articulate. Let me just bring it up right again, this rectangular drawing tool right here. And we can say to ourselves, look, we have to remain with the bullish argument moving into the week. Although the market can continue in the negative direction, it can continue to sell off, but as long as we hold above this support box, we still need to break down the market as if it is a buying opportunity. If we start to break down below these support levels, then I can answer the second question. So we've got the ranges. We're saying to ourselves, where can this market trade if it wants to continue in the bullish direction? And where shouldn't it trade if it's more so of an intermediate correction? Now let me remove this Fibonacci support and resistance, or this retracement box. This is the structure which we're operating in as we move into the week. This is the green support box. If we break this box, if we get a close below this box, then there's a very good chance that if I zoom back out onto the weekly, we are going to come back down and retest the primary level of the long-term macro bullish trend. Does that make sense? Obviously, I can't hear you, and that's why I was saying before, I think I'm going to receive a few emails over the weekend wanting me to sort of clarify this, and I'm doing my best to break this down for you as a swing trader and as a coach and as a mentor. So this is really the framework that we're operating with. Again, we're holding the bullish perspective. If this box holds, if however it fails, then there's a really good opportunity that this market is really going to sell off a lot further, and there's a good possibility that we are going to come back down and retest this old primary trend line. As such, that will be the intermediate pullback into the long-term bullish trend. Now that's really referencing the 3 levels of the trend. I've also referenced a trend is assumed to be in effect until it's given us definite signals that it has reversed. Let me go into more detail on that first tenet of Dow theory. Now again, at the moment, we are still making a series of higher highs and we are still making a series of higher lows on the intermediate type of time frame. You can see how this is going to hold if in fact we do bounce from this level. This is going to set up the next higher low in comparison and in conjunction to all of the other swing lows, or sort of the intermediate swing lows, which we have encountered along the way as we continue up and up and up. This was a little bit of a discrepancy where so we broke a perspective box. Let me put this into perspective for you. Let me bring up this Fibonacci support and resistance, and I can show you how this operates. And again, this is a really good learning opportunity for many people in this class. Again, this is very similar to what I'm breaking down the markets right now. We're saying, look, in this moment of time right here, there was a good chance that we would come down, we would try and hold the support box, but if the support box failed, then we'd come back down and retest the long-term primary trend. This is what I'm trying to explain to you as I sit here on Saturday, the 7th of March, 2015. So I hope that makes sense. It gives us a very good framework to operate on in the overall market. Now, going back into that, the trends are assumed to be in effect until they've given us a definitive signal that they have reversed. If in fact we do break this box, we set up a lower swing low, we are really going to need to pay attention to the fact that can this market rally back up above the swing high in early March 2015, what we have just experienced, or are we going to set up the first lower high relative to this swing high which we have most recently established? Now this is going to become more clear with the more price action and more data we have to work with, but this is really going into and trying to answer that first tenet of Dow theory. So again, if we fail to make a higher high, whenever we establish ourselves with some form of a support level, this is going to be key for the overall sort of intermediate time frame of the market. Very, very important tenet of Dow theory, which a lot of people misreference and as such go net short at this particular location. It's very, very risky to go net short at this location, even though the markets look as if they want to retest and at least push down into lower areas of support. I'm not disputing that whatsoever. I'm just trying to keep this analysis as level and as non-biased as possible, simply working with the technical picture. There's also another very important chart which I want to bring to your attention, and this is going to incorporate the Dow Jones transportation average. This is another tenet of Dow theory. It's actually the third of a group of 5, and let me just read through this, and I'm going to simply bring it up. It is the DJTA transportation index. There we go. I'm going to simply change to a line chart, and this has got, you know, people look at this from time to time. It is a tenet of Dow theory, and it's sometimes good to gauge what the transportation averages are actually doing. Here we are. I've got the Dow Jones Industrial Average. That is what we reference each and every weekend. That is the dark line here. And on top of that, the purple line is what we call the transportation index. We want to make sure that these are working, or they're synchronized as very close to one another as possible. And as you can see, if I zoom out over a bigger type of time frame, I want to try and remove the annotations one more time for you in this particular instance. You can see how they're very, very close to one another. Now, generally what happens is when the transportation average turns down, i.e. that is the purple line, the index, or the actual Dow Jones Industrial Average, follows suit. Now, sometimes one leads the other, but you want to make sure that they are following one another. This is the best indication when they tend to diverge from one another. You can see when we get far away from one another, it's only a matter of time until they come back into a very close type of pattern. They're very, very similar to one another, and again, they're meant to be synchronized. It's one of the tenets of Dow theory, which is very, very important. And at the moment, you can see how very close they are together. So we can sort of sit here and say that, look, the markets are are in agreement. It's not as if the transportations are diverging from the overall index or the averages index. You can see that they've both turned down, and they're indicating that potentially we're going to come back down and retest that support box, which I just drew on the chart, or maybe even break through it and set up a relative low to the swing lows in January 2015. I just wanted to reference that because that's also a very good indication of what to expect, pardon me, of these overall indexes as we break them down. Now, there's one final chart which I also want to reference, and this is what we call the volatility index, or the VIX. Let me just bring this up as well, and I'm going to bring it up, VIX. There we go, and let's see if I can hide the annotations one final time for you and bring this into a better type of reading. Now, if you're not familiar with the VIX, it sort of works like the ADX. It has a resting level, and then from time to time, when market participants become complacent, what I mean by complacent is that we get into some form of a trending market, low volatility trending market, the VIX tends to spike. And when that VIX tends to spike, it ushers in panic and fear amongst traders and investors, otherwise known as some form of retracements in the overall markets. As you can see, if I zoom in on the detail, whenever we have had a significant sell-off, or a 1,000-point plus sell-off in the Dow Jones Industrial Average, you can see the VIX tends to turn up. And again, it's a representation of the fear in the overall market. Again, you can see the VIX turning up. It just keeps repeating. What I find interesting is that if I zoom in onto the detail, yes, the Dow Jones Industrial Average, as at Friday, sold off close to 300 points. The VIX is starting to spike. Now, that's what's most important of this particular graph. It's not really too important in the way of the technical analysis. The technical analysis outside of the VIX is much more important than this overall chart, but it's always good to have a look at what the VIX is doing, and it really confirms, somewhat type of fear and potentially panic which may occur in the overall market. Now, again, a lot of people may be confused over the weekend. They're looking at the market saying, what can we expect? But at least in this analysis class, we're getting a really strong framework of what to expect moving forward into the next week. We've got our support box. We understand fear and panic could be potentially running back into the market, but we also understand that, again, there are three levels to the trend: the primary, the intermediate, and the minor. They are working in conjunction with another, and a trend is assumed to be in effect until it's given us definitive signals or definite signals that it has reversed. The VIX is spiking, the market is moving lower, the transportations and of course the industrial averages are in sync at the moment, which is also supporting a continued pullback in the overall markets. I'm not disputing that. But here's the sort of kicker at the moment. Is this a pullback which you want to trade, i.e. do you want to start going net short in overall trades? Or would you rather look at the market as a potential buying opportunity in a week or two? That's the question I'm asking you right now. Now, a lot of that question, or the major part of that question, is going to be answered in our top 13 individual trade list. But I do like to get a broader sense of the framework which is going on outside of our top 13 individual trades and put it in context of the overall market. Now, again, on Friday, this is the piece of economic data which I wanted to reference. The February non-farm payrolls came out surpassing estimates. It was one of those rare surprises. I mean, most recently for the entire month of February, where the non-farm payrolls have actually beaten estimates. It came out with a 295,000 figure. The estimates were in around, I guess, the vicinity of 240,000. So it beat it by 50 or 55,000. Yet the market, as soon as that information was released to the market capitulated to a degree. Now, you can look a bit further under the surface of what that report details and what it encompasses. There were a lot of unskilled jobs produced, i.e. there's a big increase in sort of retail and also waiters, bar staff, those types of non-skilled labor, which may not have investors too confident in the actual report itself. But this is where it gets even more interesting. When we have surpassed these types of estimates, especially with the non-farm payrolls, the market has really, or it's actually used it as impetus to push the market higher. Now, obviously on Friday, it came in very, very negatively. We were down close to 300 points. We have to start asking ourselves, is there something bigger going on under the surface? I.e., is there potential for some form of a primary trend change on the overall markets? That is the question which we are trying to answer at the moment. We've got structure moving forward, and this, if in fact it is going to be some form of a larger type of reversal or an intermediate correction, we're soon going to get the answers in this very important support box which I've drawn on the overall chart. I just wanted to include that in this weekend's analysis class because I find that very, very interesting. When we have surpassed the non-farm payrolls, the market uses that information as a very good base to push higher. Now, again, moving back into the analysis last week, there was a very strong narrative to the market and the technicals last week. We were exceptionally overbought. Now, what I'm going to do is bring up the oscillating indicators because I referenced this last week, but I also said that, look, we can remain overbought during the breakout of a trend. And that is very, very true. Now, is this just a natural snapback to the downside given these overbought readings? That's another question which I'm asking you, or at least, throwing out there so you can sort of evaluate for yourself. Is this just a natural snapback? Again, the law of gravity suggests that when we get very close to the finite level that we can really reach on the stochastics, we had readings up here at 94, 95. Ultimately we have to snap back and get into a more so neutral type of market. Now, I find this interesting, again, when we sort of include that fundamental data and we include that with the overall structure of the market. One thing which I want to also reference in this evening's particular class is the fact that we have divergence. Now, I didn't want to reference this last week because for those of you who've been in this Pivot Point Pro analysis workshop, you understand how often, at times, divergence appears on a chart. Now, again, this moves back into the tenet of Dow theory where a trend is assumed to be in effect just because we get a higher high relative to the swing high in December and January and we start to see divergence on the MACD doesn't mean that we start preparing ourselves for an ultimate trend reversal. We need additional signals. We need to make sure that the trend has fully reversed. So we're going to pay very close attention to what this market does over the next week. Do we pull back down or do we bounce and take out the swing high? That's really option number one. Option number two is we move back down, we retrace further than the support box, we bounce, we set up a lower high, and this could be something a lot more sinister. Whereas when we take out the ultimate swing low over here, that divergence indicator is really going to confirm, all right? The divergence indicator on the MACD is strongly going to confirm. This is somewhat of a premature type of indication. You can see that we've got a very nice reading on the MACD over here on this most recent bullish wave up to here. This is what we call wave one. And on this most recent wave, you can see right here that we've made a lower high on the MACD indicator. It's telling us that the momentum at least is becoming exhausted to the upside. So we're sitting here over this weekend and we're saying, look, there's a very good chance that this market is going to continue, at least downwards down into this perspective box. But now this is very important. I want you to write this down. There's no need to be fearful. There's no need to panic whatsoever, moving into the week. We've got a very good understanding of what can happen in the market. And I'm also going to tie in, of course, our other steps to trade confirmation, not only on the Dow Jones, but also on the S&P and also on the NASDAQ. Before I get into those additional steps, I want to reference again a few additional charts, which I said I would at the beginning of this recording. Now, I said get comfortable. This is going to go outside of the scope of the general weekend recording. And I'm simply going to bring up, this is very important, if I can just work with my chart. Let me just do this right here. I want to bring up the chart of the US dollar. I made reference to this during the week, and we were in another Bollinger Band squeeze on the US dollar. Let me zoom out so I can put this in context for you. Since, when was it? August? Let me go back out to the daily. Since August 2014, you can see this particular moment in time over here. Now, let me just zoom out and I can put this in better context for you. We were basing for over a year on the US dollar. We broke out of this channel and we have continued to trend higher, and trend higher. We are breaking out of resistance levels after resistance level, after resistance level after resistance level. This US dollar hasn't really had any significant retracement. On Friday, after that economic data, the US dollar absolutely soared. And you might be asking, why am I bringing this to your attention? The reason why, in a perfect world, is that The US dollar and the US markets should work inversely to one another. Now, most recently, or in recent time, this hasn't been the case, but I want to bring up this very important indication of the US dollar because it is very, very pertinent to the current state of the overall market. Here we are in the bullish trend. We're making higher highs, higher lows, higher highs, higher lows. And you can see most recently, if we compare the high in January 2015 to the most recent high as at March, look at what the MACD is doing. This is giving us exceptionally strong divergence, incredibly strong divergence. You might be asking, why are you bringing divergence into this discussion when referencing the US dollar? The reason why, again, is because in a perfect world, this should work inversely to the overall market. So as the markets are looking quite weak at the moment, I still am yet to really get into the S&P and the NASDAQ. The US dollar is really sort of signaling that this could be the last push higher until we get into a really significant correction. And what I mean by significant correction is that if I bring up the red tool, we work in conjunction with the intermediate trend. That is telling us that this US dollar has got a long, long way to correct. We may see the US dollar trading at 88, maybe even 90, around that, that round number. All I'm saying is that this could be the final blow-off rally in the US dollar until we start to see a significant bearish signal, which is going to start to align this divergence on the MACD. Now, look at the RSI. The RSI is exceptionally overbought. I mean, exceptionally overbought. Have we been this overbought in the US dollar ever before? And there are periods in time when we have. I mean, there are a few. This is us at the current juncture over here. If you just look at how many times the RSI has got to this level, I mean, not even there. I mean, we have to go all the way back to April and May 2012 to see the reading this overextended. It's only natural again to see the snap back to the downside. Now, if this occurs, this is really going to support our overall look on the Dow Jones Industrial Average because we're getting very, very close to a reasonable Fibonacci retracement. Now, I want to go one step further also in this overall market analysis. And again, this is just for your benefit. I've looked at the US dollar and it has been an incredible trade for many people who trade Forex out there. You can also break it down like this. The world is on sale for US citizens. Everything, if you want to do overseas travel, if you want to buy goods outside of the US, everything is operating at a huge discount for you at the moment. The reason why is because your purchasing power is appreciating so much in value. I mean, if I tie this into the Australian dollar, we're getting absolutely clobbered over here when I reference the Australian dollar versus the US dollar. Now, this is where I'm heading because if I bring up the US dollar, and I go down and I reference the euro, this is the biggest type of, wrong currency pair. Let me just bring up the euro versus the US dollar. This is the most, one of the biggest or the heaviest sort of Forex markets there is when we start to bring up the euro versus the US dollar. And I also, am going to tie this down into the markets as well. So just bear with me for one moment as I bring up the euro versus US dollar just here. And you can see that this is a chart of the euro losing or depreciating in value against the US dollar. You might say this, you might be sitting here and saying, well, this is looking awfully weak. Yes, it is. It is exceptionally weak. It's just breaking support after support after support. On its way down, it's moved from 1.36 down to, pretty close to 1 at the moment. It's trading at 1.08. The reason why I want to bring this to your attention is because I've shown you bearish divergence on the US dollar where we make a new higher high relative to a past high. And you see that divergence setting up on the MACD where we start establishing a lower high relative to the higher high. Sorry, that's a bit of a mouthful, but you'll get it. If I show you this chart and I show you that we're making a series of lower lows, whereas the MACD is really giving us a very strong indication of a new higher low, this is divergence. Now, this is what we call bullish divergence. So what I'm expecting on the euro at the moment is that we are going to have one final shake off to the downside, but ultimately we are going to stabilize and then reverse the trend. It may just be simply a reversal going back into that intermediate, a reversal on the intermediate time frame, back into the primary trend, going back to Dow Theory. But again, under the surface of the euro, obviously the Eurozone has started its own QE, and this may be, again, the reason why, such a significant depreciation has began in this currency. I wanted to bring that to your attention because it heavily weighs on the price of the US dollar. If this trend reverses, the US dollar is also going to reverse from its bullish trend and we're going to see a correction, which could influence the overall markets and really support the overall framework of this Fibonacci retracement box and the ultimate, continuation to the upside. So I hope you can see how I'm bringing a story to you and how it starts to fit the mold of, yes, potentially short-term pain on the markets, but ultimately continuation to the upside. That's really what I'm seeing across all three of these US markets. And I needed to walk into those three into those particular charts, to bring that information to you and to make sure that we are crystal clear moving forward into the week. So